Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. The federal government and the province of Ontario are expected to sign a deal tomorrow to reduce the regulatory burden on large projects, according to a report from the Canadian press. The deal includes the road to the Ring of Fire, and Ottawa has agreed to eliminate any duplicate work on its impact assessments on large projects. The changes will also dramatically speed up big projects across Ontario. Shares of TransAlta are trading lower, off by 4.3% right now. U.S. Energy Secretary Chris Wright has issued an emergency order directing the company to keep its coal plant open after it was scheduled to shut down at the end of the year. The U.S. Energy Department says Unit 2 of the generating station in Centralia, Washington, is a reliable supply of power and is essential for grid stability in the U.S. Northwest. The order is in effect until March of next year. Shares of Bird Construction are up nearly 4% after the company secured $1.2 billion in new construction projects. The new agreements include major industrial capital investment projects and a series of new and renewed multi-year agreements. Bird says one of the projects include work at BHP's Jansen Potash site in Saskatchewan to build 5 infrastructure buildings. And taking a look at the markets right now, another down day for the TSX. It is off nearly a quarter point, 0.22% today. And looking down south of the border at the U.S. markets, similar scene unfolding. Another rough day right now. S&P 500 off by 0.68. Dow Jones off by 0.2. And you can see the NASDAQ is off by more than 8%. As we approach the end of 2025, let's get a market recap of the year and a look ahead as well on what we can expect for 2026 and what our guest is watching for. We're joined by Nicholas Mersch, portfolio manager at Purpose Investments. Nicholas, thanks very much for joining us.
Thanks so much for having me.
All right, let's look back first. It's the way we normally do it. And 2025 to you, what were some of the drivers?
Yeah, I think flipping the page on the calendar year is also a great time to always go back and say, okay, what happened in 2025? What worked, what didn't? And then look into the next year. And I think the core theme of 2025 was really this inflection point on the multi-year CapEx cycle that is really reviving the next industrial revolution. And this is all around artificial intelligence. And if you think about the last decade, these mega cap companies were very good at scaling out in a very asset-light business model through high gross margins, low fixed cost software. But now the game's changed. This is an arms race to the next best AI systems, all through physical capital expansion. So the entire economy is going to look very different over the next 10 years than it did over the last 10, and it's going to be very much more capital intensive. So we saw everything in the entire value chain really start to take off when it comes to semiconductors, cooling systems, power units, cloud providers, everything. And build out figures in aggregate for 2025 will approach around $500 billion in terms of CapEx spend. And what was equally surprising over the course of the year was not only the magnitude, but just how quickly the goalpost just kept shifting out quarter and quarter, more and more spend. All the while. But we also got some very real concerns around debt financing and circularity. We saw Blue Owl this morning, which is one of the private lenders, walk away from an Oracle financing. And we also saw the spread for Oracle CDSs really expand over the last couple of quarters. So we saw a lot of these higher beta stocks in the space sell off starting in November. We're also starting to see a lot of that happening this morning too. So although this was the earmark year for AI, we're starting to turn the page and we're saying, okay, we need some ROI on this. We need to justify the CapEx spend. So there is some cracks in the system, but I think we're just getting started on building a lot of this, and it's going to be an incredibly exciting year next year.
And what, looking forward, let's talk CapEx first. Is there still room for that right now, or do people really want to start seeing some returns on it?
Yeah, I think there is still a little bit more in terms of room that we can run on that CapEx side. But 2026 to me is going to be this show me year that really sorts the AI winners from the AI losers. So we had 2025 was this year where a rising tide lifted all boats, but 2026 is again going to be that sorting year. And what I'm really focused on here is still the enablers of AI. So specifically, that's the companies that provide both the physical and digital layers that power these systems. And that is the picks and shovels plays, like the chips, memory, networking, infrastructure. And I still think we have room to run in these names. And if you look at NVIDIA, very much sold out still on their Blackwell, their most recent chip. And then if you look at a company like GE Vernova, they're sold out for years on their nat gas turbines. So all of these are critical bottlenecks in the ecosystem that I still think have room to run over the first half of this year. And I love investing in these bottlenecks because that usually means pricing power. But when you have to understand is that these don't last forever. And at some point in this technology cycle, the focus is going to shift from the enablers of this technology to the adopters. So those that are using these tools to increase efficiency. So AI is going to be implemented into workflows and lifting a lot of operating margins beyond just the tech-focused names. So industries are going to start to see benefit from this are pharma through drug discovery, maybe even biotech through genome sequencing. So these are some examples of the great adopters. But what I still really like here are those that sit at the intersection of enabling and adopting. So for these companies, I look at Microsoft, Google, Amazon, and these are players that have full verticalization in the entire ecosystem from silicon to applications, and they capture the entire value chain and are actually all free cash flow positive for next year, even when baking in this heavy CapEx spend. So these guys have the underlying cash flow and cash on hand that can finance this build out if it turns into a winners take most market. And if they end up also just giving stuff away for free to crowd out the market, you could see that scenario happening as well. They're also the bigger adopters of this technology because they're all eating their own cooking. They're the lowest friction companies when it comes to implementing AI because they already have it ingrained in their DNA. The market is really recognizing this with Google's performance this year, but they left behind Amazon and Microsoft, which are underperforming the benchmark significantly. And I think those names could have some catch up here.
And does this feel like this could be the year that we see big winners and big losers?
Yes, absolutely. And in terms of those that loser category, I think we're starting to see some of that in real time. Because if you look at a company like Oracle, they have a significant amount of debt on their balance sheet. And then after their earnings, they fell a significant amount. But on top of that, they came out and they said, hey, look, we have $250 million in leases that we have to sort of start committing to before 2028. And that is not really shown as a debt on their balance sheet. So when you have some of these companies that are building and building, but taking on too much debt, that's when you start to see worrying in the overall ecosystem. So you can see in that price chart of Oracle how it really had that gangbuster result after they reported a metric called RPO, which is remaining performance obligations, which just means bookings in the sense of the software world. And they said they had a massive increase in their RPO, around $500 billion. A lot of that came from OpenAI. Now people are saying, well, OpenAI doesn't have an underlying free cash flow generative business. And although they can raise a lot of capital, and they could do so also at an IPO, people are starting to question where the financing is coming from. So what we need to see here are players that can finance a lot of this growth through either free cash flow or cash on hand to really capture that ecosystem without taking on too much risk.
And just a little bit outside of this, are there any other sectors? You mentioned healthcare with especially research. Any other sectors that are early users of this, adapters of AI, and are really starting to benefit from it, and they see next year, say, being an even better year for them?
Yeah, I think if you look at even some supply chain companies, so you have companies that are going in and they're integrating their entire inventory management systems, their entire supply chain management systems, and using these AI routing tools. So you saw companies go out and really print these amazing efficiencies in terms of using this technology for predictive logistics. So companies like this that are going in and they're adopting them in these early stages are very much beneficiaries of this. And we're also starting to see it in healthcare. When you kind of get to these systems that are going out and they're expediting a lot of these different drug processes through phase 1, phase 2, and even discovery. And then you get to biotechnology and some of this genome sequencing, you can see some really exciting applications of AI actually being implemented into workflows. Now, what this does is it increases operating leverage for a lot of these companies. We've seen CEOs and even say the quiet part out loud, and they're saying, hey, look, we're cutting headcount. And a lot of this is a function of employees becoming a lot more efficient on an individualized basis. If you look over the past kind of decade, revenue per employee for S&P 500 companies has been relatively flat to a little bit up. But since ChatGPT came out, if you look at kind of the revenue per employee and the S&P 500 companies, this is all starting to go almost parabolic in terms of the growth rate. So we're seeing accelerated growth rate in terms of revenue per employees here as everybody gets a lot more efficient. Now, this has a lot of implications when it comes to the labor market, because you're going to see the labor market starting to show some cracks as we got from the recent economic data. But and this is going to reorganize some of that. But you need to focus on these companies, I think, in the second half of this year that are going to be adopting this technology a lot more efficiently.
We're going to have to wrap it up there, Nicholas. Thank you for joining us. Appreciate it.
Great. Thanks so much for having me. Appreciate it.
Nicholas Mersch is portfolio manager at Purpose Investments. Coming up, oil prices are surging today after Donald Trump ordered a blockade of Venezuelan tankers. We'll take a closer look with our own Lindsay Biscaya right after the break. Well, oil prices are surging today, recovering from the lowest close in almost a half a decade. This comes after Donald Trump ordered a blockade of certain Venezuelan tankers. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, quite the change. Oil was on a downward trend. We'll see how long this lasts, of course. But how are things right now? What's the latest on it?
That's exactly it. We'll have to see how long this lasts. But we are seeing a bit of an increase today. Brent prices, for example, at more than 2%. That's above $60 a barrel. And of course, this comes amidst this ongoing turmoil we're seeing between Donald Trump in the U.S. and Venezuela. The latest is after Trump ordered a complete blockade of oil tankers going to and from Venezuela. Under international law, a full blockade is an act of war, but Donald Trump is saying he only wants to block sanctioned oil. He also says he's designated the Venezuelan government as a terrorist organization. He obviously can't do that. You need the State Department to do that, but very strong words coming from the president of the U.S. And this is a big deal for Venezuela. As we know, they have vast oil fields. They produce about 1 million barrels a day, and their production currently represents just about 1% of global supplies. So many economists are saying this will put a very minimal dent on the market.
I'm going to have to cut you off. We're having some mic issues with you.
Yeah, I know. I hear that too. Apologies. So sorry.
But I was listening to it. It was sounding great. Hopefully people could hear part of what you were saying. We'll get that mic fixed and we'll figure it out. Now, we also had a chance to talk with Dan Hinton about some of the noteworthy stock stories of 2025, and we kicked things off with Western Digital.
Yeah, and I think we can loop in the rest of the memory space as a whole. There's all kinds of different memory, but when you think about what's been going on is there's a memory squeeze that's happened, and it's being priced into these equities. So if you look at a SanDisk, it's up almost 500% on the year. Western Digital, over 200%, I believe. Micron, and then you can go to the other side of the pond, the Pacific, and see that SK Hynix and Samsung, which are some of the big memory players in Korea, all of them have had a tremendous run. And I think the reason for that is there's a belief that memory is in significant undersupply. And these stocks have historically been cheap and deeply cyclical, and they've priced in a big recovery cycle that's been going on. So the real test will be next year is, are we going to see more supply come on, and will it truly be scarce or not? But I think all roads lead to a pretty significant memory cycle, and this is where these companies have been pricing in.
And even though it's been priced in, you still see room for it to grow?
I'm not too sure. It was more just to appreciate what the biggest movers of the year are and what it looks like going into next year. I think it's a bit of a toss-up. Memory at this scale to bring on is hard, but over time, these deficits do turn into gluts as time goes on, as with any capital cycle. But I think it might be too soon to call it the end of the memory cycle early next year. Yeah. But maybe mid next year to late next year might be a different story.
And Seagate is one of those similar as well?
Yep.
All the same situation for it, eh?
Different types of memory, different types of end uses, but the underlying driver is all the same.
I just saw a new word, DRAM.
DRAM,
Or is it DRAM?
It's DRAM.
I like DRAM. I'm Scottish. I'm half Scottish. I'll go with that. Robinhood.
Yeah, that's been one of the other successes of the year. Yeah. And I think, once again, for Robinhood, when you see what's happened, it went from being effectively, call it undervalued, and then there was a decent-sized crypto cycle during the balance of this year. A little bit less so recently, for sure. There's been a lot of retracing back. But they basically are call it the younger generation's Charles Schwab.
Yeah.
So it's in the zeitgeist, it's popular, and every crypto cycle tends to bring in more users, more accounts for them, and then they can hold on to those accounts for, call it, strong net new asset growth as time goes on. So you basically lock in the customer, bring them into your ecosystem. Whether they make money or lose money, day trading is really besides the point for Robinhood. It's as long as you just throw that extra paycheck and those savings, and this is your store of value and your wallet for making investment decisions in the future. And it's been executing really well. I think this is one of those companies is when you take a step back, take the crypto conversation out of it, it's basically going to lead in fractional trading, private market shares, and we've been seeing this convergence of public-private markets where there's a gray zone because SpaceX is worth $800 billion in the private markets. A lot of the big AI labs are privately funded at $500 billion today. Was the news with Amazon and OpenAI.
Yes.
Right? So those are all private. Robinhood can probably bridge that gap in a way that the other, call it, legacy discount brokerage companies cannot. So it's an impressive company, irrespective of the stock price move one way or another.
And what do you think of it starting to the custom sports parlays? Is that
yeah?
Is that anything to it, or
yeah? I mean, if it's a way to do gambling without having a gambling license or a gaming license, as it's called. And I think it's one of those things where if you call it sports betting or prediction markets, that's a very veiled way of saying I'm going to bet on the coin toss of the next football game, or in the third inning will there be a strikeout, things like that. So this is one of those things where, as with actually tobacco and nicotine consumption, markets will move at their pace, and regulators are going to catch up probably too late. And I think this is going to be the dynamic here as well. So Robinhood is one of those players. Interactive Brokers is one of those players. Kalshi and Polymarket. All of these companies have, in different capacities, large platforms behind them. So you can bet your dollar that it's going to come through in a big way on these platforms, and we're going to see call it a golden age of gambling pick up.
Okay, let's get one more in. We're almost out of time. Palantir.
Yeah, I think this is a classic case of one of the most purest expressions of AI native companies, and they call what their go-to-market is what's known as forward deployed engineers, which was call it a spin on what they used to do with the U.S. military, where they would have engineers sitting in Afghanistan and things like that, helping to solve the military's problems. They're taking that go-to-market approach for the enterprises, where if you're a business, a Palantir engineer will come in and help solve your AI problems. So it's a phenomenal model. It's actually a very profitable company in its own right. The CEO is a bit eccentric and what have you, but it's a retail darling. So is it worth 50 times sales? I wouldn't be so sure about that, versus when ServiceNow is worth 15. But it's one of those things you got to respect good execution where execution has happened, and Palantir is absolutely one of those companies.
All right, that was Dan Rohinton, portfolio manager at IA Global Asset Management. Okay, we're going to bring Lindsay back in, talk about the oil prices that are surging today. We had some little technical difficulties with the microphone, but
it's fixed now.
It's all fixed.
Yeah,
we're going to talk about the situation that's unfolding off of Venezuela, the blockade, but not blockade. Donald Trump ordered that. I'll send it back to you now.
Yes, exactly. Thank you. So that's kind of the big story coming out today is Donald Trump ordering that blockade of tankers that are coming in and out of Venezuela carrying oil. Because of this, Brent prices up more than 2% today. This is the first increase we've seen in quite some time. That's above $60 a barrel. And this, we'll have to wait and see how long this lasts. Obviously, this does have an effect on oil prices because, as I was just saying, Venezuela does have vast oil fields. They produce about 1 million barrels a day. But according to most economists, their production currently represents less than 1% of global supplies. They ship most of their oil to China, about 80% of it, and about 16 to 20% now gets usually exported to the U.S. So any impact on the market will apparently be minimal. We're seeing a bit of an impact today, but it's not expected to be long-lasting because we're dealing with that oversupply in the market, that expected glut in the new year where there's more supply than there is demand for oil. And so most economists saying we'll have to wait and see what happens in the long run. But today, because of this, and because of some potential new sanctions coming against Russia, which is like a whole other story, whether Russia accepts a peace deal on Ukraine or not, that depends on whether the U.S. adds more sanctions on Russia. That is impacting the price of oil as well today. So all these geopolitical factors are bringing the price up for the first time in a while, but it's not expected to really have a big dent in the future on the price of oil overall.
All right. Any impact on the Canadian oil industry?
Yes, we just heard from Dan Hinton. We're going to hear from him again in a moment
yeah.
because you were talking with him today.
Never have too much Dan on the show.
He's very knowledgeable, and he was saying that it's probably not a very good impact on Canada. He was talking about the oil in Venezuela. It's very heavy crude oil, very much like the oil that Canada produces. Takes a lot of engineering to extract it from the ground. It's very expensive to extract, and for that reason, it is more expensive. So it's not as profitable. Same with Canadian oil. But this is part of the reason the U.S. has been importing more Venezuelan oil instead of Canadian oil when you're talking about heavy crude oil. And so Canada may need to, this is according to Dan Hinton, may need to diversify. It seems as though we got into the oil production game and really starting to ramp up oil production, especially with this potential new pipeline in Alberta coming. We're a little late on that. So Dan Hinton talking earlier today about that and how this is going to impact Canada. Here's what he had to say.
When you think about oil prices and where the direction of travel is going, we are moving into a post-oil scarcity world in the next 10 years. And I don't think I would have said that many years ago. And the reason for that is the amount of solar that's being put into the ground, all the other natural gas peakers and baseload that's being spun up, on top of the fact that nuclear is having its moment in the sun once again. All of these things is abstracting away the energy use case. So 100 million barrels of oil a day, will it be more 10 years in the future? Of course it will. But it will not be the primary bottleneck energy source in the way that it's been historically, and that's generally bad for prices. And then the whole question is, we talked a lot about Venezuela, we talked a lot about Russia. What does it mean for Canada? Canada's wealth and prosperity is anchored to the energy markets. And the pipelines aren't full on the way out of Alberta right now. That is an interesting thing to monitor, and we're probably going to have to find other sources of competitiveness in our national economy, because the same reason that the Gulf states have moved on, we've been slow to extract it. And I think that moment in the sun for oil has passed.
Maybe not what all Canadians want to hear. Not all economists agree with that. You know, you hear some people say that there is still a place for oil production and for Canada to export its oil to other markets. But when you look at the price of Canadian oil today, Western Canadian Select, it's down to about $41 a barrel. When you look at the price of it back in June, it was $65 a barrel. So it's dropped quite a bit. So it's interesting. Yeah, $41.90 at the moment. It's interesting to see what the future might hold for Canadian oil and oil around the world. Necessity
spurs creativity sometimes, so we'll have to see.
Yeah.
We'll have to reinvent and see what happens with it. Okay, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscay. Well, the Canadian government and AI leader Coveo announcing a new partnership to boost the growth of AI in Canada. We'll have more on that next. Montreal-based AI leader Coveo and the Canadian government announced a partnership of a memorandum of understanding to boost innovation and adoption of AI in the government. Let's get more on this from Louis Tétu, chair of Coveo. Louis, thank you very much for joining us.
Morning, Roger.
Tell us a little bit first about the partnership, what we will see with this.
Well, I think what the government is very intentional about right now, Roger, is the idea of modernizing the government with technology and AI in particular. There's a significant opportunity to leverage AI technology for Canadians, to help Canadians to self-serve in particular, and help government workers to obtain better information to serve Canadians. And that's a key low-hanging fruit that potentially is $1 billion plus cost savings opportunity for the government, and frankly can give back time to Canadians. And that's what we're going to explore together.
Have you worked with government before? Do you think you'll be met with resistance within it?
Yeah, well, we work across the world. I mean, Coveo is an internationally recognized leader in applied AI, in applying AI models into secure data. We do 98% of our revenue internationally, and we do work in that context with the government of Australia, with the government of New Zealand, with institutions like the City of New York and others, and of course thousands of international brands and so on. So, in particular, with the Canadian government, we've been a provider of fairly basic search engines. We haven't yet deployed generative AI at full scale and so on. But as I said before, Roger, there's a significant opportunity to explore that and something that can be realized, in our opinion, fairly quickly.
How important is it that the government set an example, essentially, when it comes to AI?
I think it's really, really important. Minister Solomon, Minister Lightbound, and even Prime Minister Carney are very intentional about their desire to first create a sovereign Canadian AI infrastructure that is industrialized, so that, number two, the Canadian government can gain the efficiencies it should be looking for from that technology. And three, really being a catalyst for the broader adoption of AI within the Canadian economy. And help basically catalyze, that adoption by Canadian businesses as well as institutions. So for all those reasons, we're seeing the government, as I said, being very intentional and moving very quickly around that. And we're certainly pleased that we're able to see together how we can contribute to that.
Now, we have struggled, though. I read that article you had a couple of weeks ago, I guess it was, and you talked about we have 10% of the top-tier AI researchers in the country, but we're not fully utilizing that and taking advantage of that.
That's correct. I think this is the history of Canada, and it's really great news that there's such a reversal of event. What I often say, and I've been personally involved in building fairly large-scale public software companies across the world for the past 30 years, and I've seen more than often Canada being really, really good at science and research, but failing to monetize and industrialize. And in fact, oftentimes, we've trained arguably some of the best talent in the world, and we've given it away. And we've been a net exporter, I think, of talent and IP. And this was mainly, the observation. I think now there's a definitive, there's a real intent on the part of the government to, really apply AI, industrialize AI in particular, and technology, more broadly into the Canadian economy, to transform the Canadian economy, make it more productive, make it more efficient. Let's face it, we are behind, but there's a clear opportunity. I think it's a real railroad moment, the way I say it, for Canada, and I think the current government, I'm certainly pleased to see the current government being so intentional and moving fairly quickly on that, not only with companies like Coveo, but with Canada's talent and IP and technology companies in general. And so I see that as we see it as very, very positive, and we think it's going to have obviously a very positive impact on companies such as ours.
All right, it's Christmas time. What more would you like to see from the government to help to further this along?
Oh, I think I would love to see the government, and I've commented on that in those articles I authored in the Financial Post and so on. I would love to see our government stop the nonsense of paying foreign companies to come and hire our talent domestically. I think foreign companies should pay us to hire the produce of our education and come and establish themselves here, because we need that talent. Fundamentally, AI is not a technology war only. It's going to be an energy war, and it's going to be a talent war. And I think we're well positioned to do that, to the extent that we become very attractive to talent. The H-1B in the U.S. is a huge opportunity. Number two, that we produce more talent, and number three, that we keep it domestically within our government, within our institutions, within our businesses. And I think that's what we're going to see. We're going to see more of that, and that's I think a very positive thing.
Okay, Louis, thank you very much for joining us today. We appreciate you taking the time.
Pleasure, Roger. Thanks for having me.
Louis Têtu is the chair of Coveo. And coming up after the break, we are going to take a look at the news from Ford announcing it's pulling back on EV plans. We'll dive into that, and also how Trump's policies are reshaping the industry. Shares of Hut 8 are soaring today after the Bitcoin miner signed a 15-year, $7 billion U.S. lease with FluidStack for IT capacity at its data center campus in Louisiana. Hut 8 has also entered into a partnership with Anthropic and FluidStack to develop and deliver up to more than 2,000 megawatts of AI data center infrastructure for Anthropic. And we're watching shares of Warner Brothers and Netflix today. You can see they're going in two different directions. Warner Brothers down 1.14, Netflix up by 1%. And of course, Warner is advising its shareholders to reject the hostile takeover bid from Paramount in favor of its original agreement with streaming giant Netflix. Warner is deeming the Paramount offer inferior and inadequate. Executives from both Paramount and Netflix have argued that they would be the best owners to utilize the Warner library to boost streaming operations. The Bank of Nova Scotia is planning to revive the metals trading desk it dismantled at the peak of the pandemic. The new desk will trade, lend, and hedge raw materials, including precious and base metals. Scotia is now looking to hire commodities traders, sales specialists, and strategists to staff the unit. The move follows record-breaking rallies in gold, copper, and silver that have renewed interest in metals trades. And taking a look at the markets right now, the TSX still off, although it's got a little better. It's down by about 0.14% right now. And when we look south of the border, it's a similar situation. Everybody in the red right now. S&P 500 off by 0.75 points. Dow Jones off by 0.18, and Nasdaq, look at that, down by 1.22%. Ford is taking a $19.5 billion U.S. write-down, as well as killing several EV models as U.S. President Trump's policies continue to reshape the EV market. For more on this, we're joined by Garrett Nelson, Senior VP and Equity Analyst at CFRA. Garrett, thanks very much for joining us.
Thanks for having me.
Your thoughts on this news, initial thoughts?
Yeah, our thoughts, we were a bit surprised by the magnitude of the write-down. $19.5 billion is a lot, especially considering that Ford didn't have the EV investment or exposure that General Motors had, for example, their arch rival, and many other automakers. So, Ford has kind of taken a more balanced approach compared to some other automakers in growing both their hybrid exposure and their pure battery EV exposure. So we were a bit surprised by the magnitude of that. That said, we have seen write-downs from other automakers. GM took about a $1.6 billion write-down in October related to their EV assets. So it wasn't surprised that they took the write-down. The magnitude was a surprise. And the big positive was, commitment to really growing their hybrid portfolio longer term between now and the end of the decade. That's the vehicle type, the powertrain type that's really in demand among consumers right now.
And just going back, any indicators as to why the write-down was so large?
Yeah, I mean, it's related to their battery investments, some plants that had been converted to EVs. So, they were taking those steps, and basically, last November happened, and President Trump won. And so, shortly after that, obviously, you had the Trump administration and Republicans, take steps to end the federal EV tax credit. It was a $7,500 EV tax credit on new vehicles that expired at the end of September. And so I think that's why you're seeing in the aftermath of that, some of these impairments being taken.
And now we still see, we see Chinese companies really pushing for EVs. Europe still is, although Volkswagen just kind of backed off just an announcement on their battery business. They're trying to find external funds for it. Is this the way to go in North America, I guess? Is there a market for what they're looking for with the hybrids and for the extended EV? I think they still want to do the extended range as well, right?
That's right. Our take is it was always a little bit too early, and that the hybrid was going to be sort of a bridge vehicle between internal combustion engine and electric vehicles, which we still do think is the future of the auto industry. But this is a move really intended to cater to what consumers are interested in. The good news for Ford is they have had a lot of success with their hybrid models. mainly the Maverick pickup and the F-150 hybrid pickup. They've had a lot of success, and they plan to introduce hybrid models of other vehicles, in the coming years. So they've had more success than some of their other competitors, but still they lag behind a lot of the Asian automakers, which have made a heavy bet on hybrids. You're talking Toyota, Honda, Hyundai, Kia. Those are the companies that we think are really going to benefit in terms of market share gains over the next few years because of the very heavy investments that they've made in hybrids, sort of shunning EVs in the process relative to other automakers.
Now, what do you like about the hybrids that you think that may be the future, and can Ford catch up to everyone else there?
Yeah, for one, they're just much lower priced than the pure battery EVs because the battery is much smaller. They have a battery. In a lot of cases, these vehicles are capable of going 40 to 50 miles on pure battery charge. And so, you think of the average person might not drive 40 or 50 miles in a day. And so they could essentially drive on battery only charge without using any gas. So that's a big positive. And then the ability to, I guess the number one, the lack of charging infrastructure, the build out's just not there, especially in certain areas of the country. And then the ability to take a long road trip and not having to stop for a long period of time to charge the battery. So there are a lot of, but the main reason is probably the price point, and that's why consumers have shown more interest in hybrids. And we expect it to be the fastest growing powertrain type by a wide margin over the next few years as a result.
Okay, we're going to have to leave it there, but Garrett, thank you very much for joining us.
Thanks for having me.
Garrett Nelson is Senior VP and Equity Analyst at CFRA. Coming up, markets face multiple headwinds this year as 2026 nears. Could inflation and geopolitical tensions keep equity risks alive? More on that when we come back. Several factors have impacted the markets this year. As the new year approaches, we might see inflationary pressures and geopolitical tensions continue. For more on how they can pose risk to equity markets in 2026, we were joined earlier by Lyle Stein, president at Forvest Global Wealth Management.
We just used our wonderful AI tools, and we asked, what are the biggest risks to the market in 2026? And the elements that came up were, at the top of the list, inflation concerns. Second one was, the geopolitical concerns around the world, and then the usual market valuations and things like that. The interesting thing as we look at 2026 is the layout of trying to forecast markets by forecasting what's going on in the world. And as we look at 2026, it's almost going to be as important to forecast what's going on in markets to see what's happening in the world. And that all fits into that K-shaped economy that people talk to. The notion that those who do well are doing really well, but the bulk of people are on the downward slope of that K. So the economic recovery that is milquetoast is being fed by the high earners, high asset owners, and there's still a lot of pain amongst those who aren't participating, those without assets, those without houses, those who are concerned about their jobs. And so all this is in the mix for 2026.
I suppose the richer people tend to own stocks, and they're feeling rich with markets near record highs.
And that's exactly it. I mean, the AI boom has been very important for the U.S. economy. We know that. It's about half of economic growth in 2025. But the wealth that's been created by the AI boom has been particularly good for those who own stocks. And so that is a big driver. If we lose the momentum in the market of those who own AI stocks, because it does look like they're getting a bit tired. NVIDIA is the poster child there. Mm-hmm. That could have an impact on consumer spending, which has an impact on the economy. And it could also have an impact on all the ETFs that own the NVIDIAs and the big hyperscalers.
Wow. Do you think we could, well, we've talked about this for years, that we could see a flight from index funds and then it would turn into a self-fulfilling thing because the index funds, as they get redemptions, would have to dump those big tech stocks?
That could very well be the case. And now the interesting thing is we're just coming to the end of tax loss selling. Nobody sold those stocks this year because you've got a big tax loss. Now, through 2026, will that in fact hit the market? It's a tough thing to call. We won't be able to make a forecast on whether it'll be ETF redemptions, but we could see a slow drip out of them. And that would be consistent with a general multiple decline in the market, which would be exacerbated by fears of economic slowdown.
What do portfolio managers tend to do at this time of year, Lyle? We hear about window dressing. What are the main goals here?
Well, the number one is just to finish the year on a good note is the most important thing. Window dressing, the notion that I wanted my portfolio for December 31st to look like more of the index, more of the things that won. I think that's been somewhat lost with, as you said, the rise of ETF investing. But active managers, don't want to be too far offside if they're managing funds that are on a relative performance basis. At our shop, we're more absolute performance than relative performance. And so we don't mind if we have what we would call in the business bets on certain areas of the market and then bets against other areas of the market. So again, that window dressing applies primarily to index huggers, not active managers looking with a total return bias.
I guess people think there's a safety in numbers, a herd instinct among portfolio managers, and they tend to hold the big funds anyway, very much the same stocks.
Well, and that's a big risk here because you got to be the smarter guy is the one who's going to be ahead of all the rest. And so once the first button pusher goes, everybody else will pile on. That's where it gets really tough. That's why as we look at the world for the next 1 year, 3 years, we have a consensus view. We know what that is, but you have to ask, where is the consensus going to be right or wrong? So it's almost better to look at the analysts that have the lowest estimate on a particular stock and the highest estimate than it is to look at the consensus number and see how that's changing.
What about trade and tariffs? I mean, that's a very broad topic, but we are going to get the renegotiation of the, or beginning of a reworking of the North American trade agreement next year. Of course, we'll get lots of pronouncements and heat and noise from the White House, but is that a thing you're paying much attention to? Obviously important for the Canadian economy.
I think it's particularly important for Canada relative to the rest of the world. We're still living with, very high tariffs imposed upon us. And if we lose the NAFTA agreement, we're at risk of seeing even further tariff increases, just given the appetite for Canadian-American relations right now, it isn't necessarily that great. But more importantly, we've got the big decision we think is coming maybe this year, maybe early next year on what happens with those tariffs at the Supreme Court. We've heard also that companies are holding off increasing prices till they get some clarity, perhaps from the Supreme Court, before they might raise prices in the first half of the next year. And then there's all this discussion about, well, if the tariffs roll off, that'll be more of a second half of next year. So the tariff uncertainty is pretty high. I think you have to, again, look at it in the context of the securities you're owning as opposed to the market ETF that you own.
Yeah, I mean, in fairness to Prime Minister Mark Carney, the tariffs, there's big levies, as you note, on steel, aluminum and lumber, but we've dodged the worst of it because if they're covered by the North American Free Trade Agreement, Trump isn't tariffing them right now.
Well, that's right, and that's the risk that we face if, in fact, the NAFTA, or sorry, the USMCA is torn up. If that's torn up, then we could face some additional pain. But again, I think we'll get clarity out of the Supreme Court.
And he was speaking with Lyle Stein, president of Forvest Global Wealth Management. Coming up, we'll check in on the markets on Bay and Wall Street. Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. And Market Call is coming up next. Today on the show, we have Chris Blumas. He is the portfolio manager at Raymond James Investment Counsel, and we'll be taking your questions on North American large caps. All right, let's take a look and see how the markets are doing on Bay Street and Wall Street. We'll start with Bay Street right now, and it is off, but it's edging back into green. It's still down, though, by about 0.1%. And one of the ones we just had an interview, of course, with the head of Covea. And how are they doing right now? Oh, we'll start with Hut 8. We'll move to them first. Hut 8 is in the news today. And taking a look at them, how are they doing right now? They're up 12% on that $7 billion fluid stack data center deal. That's helped driving them up right now. And they're in a good mood right now, not surprisingly, with the numbers that we're seeing right now. And another one that we talked about earlier, Covea, if we can bring that up. And they are also surging right now in the news that they have a deal with the federal government, Ottawa, to work with them to develop AI within the federal government. We were talking earlier, and they said that it could mean up to $1 billion in savings using AI within the government. Moving over to Wall Street, how is Wall Street doing right now? You can see that they are, that slide continues in New York right now. The S&P 500 off by 0.86%. The Dow Jones down by a quarter, and the NASDAQ is off by 1.33%. One of the ones taking a hit, Oracle, if we can just pull that up quick, they are off today about 4.5%, almost 5% right now on the news that they're going to do those final negotiations on an equity deal for a data center project in Michigan, but it won't include Blue Owl Capital. And that is it for us. Thank you for watching Morning Markets. We'll see you back here tomorrow.